All right, guys, welcome back for another video. In today's video, I want to talk about the Bitcoin cash and carry trade and also Ethereum staking rewards and tie the two ideas together. So right now we're looking at Glassnode data. It's just showing you the exaggerated price that Bitcoin futures contracts traded at during the bull market. And you can see that, things got pretty extended at the peak of at the bull market peak. And, this represents a unique opportunity for institutional investors to come in and step in and take advantage of that premium. If really it represents a risk-free opportunity, take a hypothetical scenario where you have a, institutional money manager managing $1 billion. Well, when the premiums were trading that high in the bull market, that manager could step in, buy the Bitcoin spot underlying, and then turn around the next minute and hedge with futures contracts 1-to-1 and capture that double-digit premium. So that's a double-digit return, instantly and risk-free. And if you're managing $1 billion, you just made $1 million, over $100 million risk-free in very little time. It's a no-brainer for these guys to step in, take advantage of that. And of course they did. You see that the peak of the those premiums really marked the top of the bull cycle. Of course, you did get rallies after that, but I interpret this as the big boys stepping in, arbitraging those premiums, and that really was like the end of the bull cycle. Of course, there will always be bull cycles in the future, and the premiums will rise during those bull cycles. This will tie into the Ethereum staking rewards, but before I talk about that directly, I just want to frame the concept of Ethereum staking. So after the proof of work to proof of stake merge in Ethereum coming soon, people will be able to stake Ethereum, and lock up their Ethereum tokens for a fixed amount of time and earn yield on that. And that's referred to as a staking reward. Now, people speculate and, think what could or what would the yield be on those staking rewards. But most people who know what they're talking about think it's somewhere between 5 and 12%. So for the purposes of this exercise, I'll just use the number 8%, just to be conservative. So it's a hypothetical scenario where you need to stake 32 Ethereum as a validator. So you've got 32 Ethereum staked, and I'll use the number 5 years, earning a hypothetical 8% yield. And in this scenario, if you run the numbers, you can see that the only way that this trade loses money is if the underlying token, the Ethereum token, loses 30% of its value over the course of the next 5 years, which, as you guys probably know, that's extremely unlikely, considering crypto cycles, right? Every 4 years in crypto goes up in value exponentially. Of course, Ethereum can go down in the next month or so, but if we're talking a 5-year time period, that's an extremely unrealistic scenario. But you can also think about that 30% number as the yield, right? The 32 Ethereum staked for 5 years is going to generate a 30% yield. But the interesting part is that yield is denominated in Ethereum and not fiat currency terms. And where that gets interesting is when you think about hedging your currency risk. So in the bond market, anybody doing a positive carry trade in the bond market is going to be well aware of the risks of sovereign default, right? That is something that's going to factor into your risk-adjusted return calculation, right? It's not just the yield, it's a yield in relationship to the risk of sovereign default. That's why you see all these developed countries and some of their bonds trade at extremely high yields, right, in the teens, 12, 13, 14%. But but then at that point, you need to go into the currency markets and hedge your exposure and hedge against that risk of sovereign default, because these developed countries just have a higher risk of sovereign default. And when you do that, the risk-adjusted return basically normalizes to the level as if you were doing a positive carry trade in like a more established currency with less risk of sovereign default, like the USD or the euro. So it's always something you got to keep in mind. Now, where it gets really interesting is And if you're doing a positive carry trade in the bond market, you have to pay to hedge your currency risk, right? It reduces your return um, for a whole host of reasons that would be a video in itself. But basically, if you're hedging your currency risk in the bond market, that's going to lower your return. That's why it normalizes the returns. But what's really interesting is that in the Ethereum market, or the Ethereum USD market, or any Ethereum fiat market, it's the opposite. You actually get paid to reduce your risk of your currency risk. Now, what would the currency risk be in Ethereum? Well, it would be the risk of network failure, right? And whether you're extremely bullish on Ethereum or extremely bearish, right? So everybody has to acknowledge that in any proof of stake system, there is a non-zero chance of network failure, right? And that may be different for different people, but there is an incentive to go into the market and hedge that currency exposure when you consider that, uh, you know, not only is your underlying denominated in this native Ethereum token, but so are the yields denominated in Ethereum. So it would make sense to hedge the risk of network failure by going into the market and hedging it on the futures. But again, the beautiful thing about this is generally Ethereum futures trade at a massive premium, even higher than Bitcoin. So this, it's a really unique thing that doesn't exist in the positive carry trades in the bond market, and really opens the door to a lot of institutional investment, especially when you consider that when you consider how much you get paid to hedge your currency risk, it almost makes the trade incredibly risk free. And you can think of that, the gap between whatever the cost of capital is you're using to borrow money, say it's 2% or 3%, and the difference between that and the Ethereum yield, which for this purposes of this example we're using the 8% number. You can think of that as the interest rate spread on the Ethereum yield, as we should say, and the your treasury bond or whatever other financing instrument you're using. Now that is the incentive that's going to draw institutional investors into the Ethereum market to take this positive carry trade. And if you believe in interest rate parity, which whether you believe in it or not doesn't really matter. It's almost like a law of nature. You know, uh, money will chase yields. That if one currency has higher yields than another, then that currency necessarily will strengthen against the currency with lower yields. That's interest rate parity, and I think we're going to see that play out in Ethereum um, to extreme degree. I think you're going to see a lot of institutional adoption of Ethereum and these staking rewards, particularly among investors who used to be bond investors. Right now, the bond market is just not an area where investors can really churn a profit. They're really backed into a corner in that market. But those investors, those bond investors, I believe, will realize the opportunity to interact with Ethereum the same way you would interact with a bond in a positive carry trade, and that'll draw them into the market. Even especially considering that they can make it an environmentally friendly investment. Considering how Ethereum is touted as being extremely environmentally friendly, so it's not only is it profitable, but it's good PR as well. And for those reasons and a lot of reasons I mentioned before, you know, um, I do think this is going to be a huge thing people talk about. But it's also something that normal people can do, assuming you do have 32 Ethereum. Now that number will over time get further and further out of reach for the normal person. But as of right now, normal people can take this trade. And again, this is not financial advice, um, but just just an interesting idea. I think this is something we'll be seeing a lot more of in the coming weeks, months, and even years. Anyway, I hope you guys like this content. If you do like this content, just leave a like on the video, subscribe to the channel, and I'll catch you guys in the next upload.